Federal Reserve. Founded in 1913, the Federal Reserve is the central bank of the United States. It carries a dual mandate: stable prices and maximum employment. No other major central bank holds both obligations simultaneously. It sets the federal funds rate, which determines the cost of overnight borrowing between banks. Because the dollar is the world's reserve currency, that rate influences borrowing costs in nearly every economy on Earth. When the Fed moves, every other central bank is watching. Riksbank. The Riksbank is the oldest central bank in the world, founded in Sweden in 1668. It pioneered the use of banknotes in Europe and has served as a testing ground for monetary ideas ever since. In 2015, it became the first central bank to set a negative policy rate in peacetime, charging banks to hold reserves rather than paying them. The goal was to push money into the economy by making idle savings costly. The experiment produced mixed results and was eventually reversed. Bank of England. The Bank of England was founded in 1694 to lend money to the government. It gained operational independence from the Treasury in 1997, meaning politicians no longer set interest rates. Its Monetary Policy Committee votes 8 times per year on the base rate. It targets 2% inflation. It also issues sterling banknotes in England and Wales and supervises the stability of the British financial system. European Central Bank. The European Central Bank was established in 1998 to manage monetary policy for the countries that adopted the euro. Its sole mandate is price stability, defined as inflation, close to but below 2%. It cannot directly finance member governments, a restriction built in to prevent weaker states from pressuring the ECB for cheap money. During the 2012 sovereign debt crisis, that restriction was tested until the bank's president pledged to do whatever it takes to preserve the euro. The phrase alone calmed the bond market without the ECB spending a single euro. Deutsche Bundesbank. The Deutsche Bundesbank was established in West Germany in 1957, shaped by the institutional memory of Weimar hyperinflation. It built its entire identity around price stability as the primary obligation of a central bank. When Germany joined the Eurozone, operational control transferred to the European Central Bank, but the Bundesbank's hard money philosophy became the dominant culture inside the ECB. It remains the largest national central bank in the Eurosystem and still publishes independent economic analysis. Bank of Japan. The Bank of Japan has spent more than 3 decades fighting deflation rather than inflation. It adopted quantitative easing in 2001, well before any other major central bank. In 2016, it introduced yield curve control, directly targeting the rate on 10-year government bonds, rather than just short-term rates. By 2023, it held roughly half of all outstanding Japanese government bonds. The result is a central bank so deeply involved in the bond market that unwinding its position without disruption is one of the most complex problems in global finance. People's Bank of China. The People's Bank of China is the central bank of the world's second largest economy. It does not have formal independence. It operates under the direct authority of the State Council and carries out government policy on exchange rates, credit allocation, and financial stability. It manages the yuan within a daily trading band set by the government each morning. It also holds the largest foreign exchange reserves of any institution on Earth, over $3 trillion, accumulated largely to keep the yuan from appreciating and hurting Chinese exports. Swiss National Bank. The Swiss National Bank is unusual because it is a publicly traded company. Its shares are listed on the Swiss Stock Exchange. Its mandate is nonetheless public: price stability, and, where compatible with that, supporting economic conditions. In 2011, it capped the franc against the euro to prevent appreciation from making Swiss exports unaffordable. In January 2015, it removed the cap without warning. The franc rose 11% in minutes. It was one of the sharpest single-day currency moves in modern history. Reserve Bank of New Zealand. The Reserve Bank of New Zealand invented inflation targeting. In 1989, it became the first central bank in the world to adopt a specific published inflation number as its legal objective, with the governor held accountable for hitting it. Before that, Central banks operated with general price stability mandates and no binding numerical commitments. New Zealand published a number, set a band, and wrote the accountability into law. Canada, the United Kingdom, Australia, and eventually dozens of other countries followed. The inflation targeting frameworks in use today trace directly to this decision. Bank of Canada. The Bank of Canada was established in 1934 during the Great Depression. It adopted inflation targeting in 1991, one of the first to follow New Zealand. Its target is 2% within a 1 to 3% band. That target is renewed every 5 years in a formal agreement between the bank and the federal government. The renewal process is rare internationally. Most central banks set their own mandates. Canada negotiates its in public. Reserve Bank of Australia. The Reserve Bank of Australia targets inflation between 2 and 3% over the medium term. It meets 11 times per year to set the cash rate. It is also responsible for the stability of the payment system and, under its charter, for the economic prosperity of the Australian people broadly. The breadth of that mandate gives it more latitude than strictly inflation-focused peers. Australia went 28 years without a recession before the pandemic, a record in part attributed to the bank's willingness to ease policy earlier than comparable institutions. Reserve Bank of India. The Reserve Bank of India was founded in 1935 under British rule and nationalized in 1949 after independence. It manages the rupee, holds foreign exchange reserves, and supervises commercial banks. Since 2016, a 6-member Monetary Policy Committee sets the benchmark rate, with the governor holding a casting vote in the event of a tie. The bank also performs a developmental function, directing credit toward agriculture, small business, and rural infrastructure. That role separates it from most advanced economy central banks, which treat credit allocation as outside their mandate. South African Reserve Bank. The South African Reserve Bank was established in 1921, the oldest central bank on the African continent. It is one of a small number of central banks with private shareholders, a structural remnant of its founding. Despite private ownership, it operates with full policy independence. Its mandate is price stability in the interest of balanced and sustainable economic growth. It targets inflation between 3 and 6%, a wider band than most, reflecting the volatility introduced by commodity prices and a floating exchange rate subject to sharp capital outflows. Banco Central do Brasil. Brazil's central bank was formally established in 1964. For decades, its independence was contested by governments under pressure to finance deficits cheaply. Inflation reached over 2,000% annually in the early 1990s. The 1994 Plano Real brought it under control, and the political credibility that reform generated made formal institutional independence thinkable. In 2021, Brazil passed a law granting the central bank legal autonomy, with staggered fixed terms for its governor and directors. The terms are designed so no single president can appoint a majority of the board. Bank for International Settlements. The Bank for International Settlements is not a national central bank. It is a bank for central banks. Founded in 1930 and headquartered in Basel, Switzerland, it provides banking services to member central banks, holds their reserve accounts, and serves as a forum for governors to meet privately. It also hosts the Basel Committee on Banking Supervision, which sets the capital and liquidity standards that commercial banks worldwide are required to meet. The standards have no legal force on their own. They work because every major jurisdiction agrees to implement them. Thanks for watching. Which central bank model do you think works best, and why? Let me know your thoughts in the comments down below. Also, please remember to like and subscribe if you enjoyed this video.